And joining me for a further look on what's playing itself out on that market scene is Jacobus Brink from the Schmidt Family Office. Jacobus, always a pleasure and a good afternoon to you.
Good afternoon.
All right, Jacobus, we're seeing red screens today, but we've seen a bit of a mixed week. Low volumes, though. I'm keen to get your take on the stocks and globally here at home over the course of the week.
Yeah, so it's, as you mentioned, fairly thin volumes around with the US having a long weekend, Thanksgiving weekend. But yeah, a bit of a mixed picture sort of from the macro side. You know, some of the data we saw earlier during the week, I think of particular interest was some of the Michigan inflation expectations we saw out on Wednesday. Those actually came in higher than expected. So we're getting a bit of a mixed picture as far as inflation is concerned with what the market's currently pricing. You know, we've seen bond yields come down substantially over the last number of weeks as the market's sort of pricing in, you know, Fed rate cuts possibly earlier, despite the fact that we've heard quite a bit of hawkish rhetoric from the various Fed officials. But you know, that sort of almost seems to change on a weekly basis as well. So yeah, a little bit concerning. The one-year inflation expectation number came in at 4.5, which is still considerably higher than the Fed sort of the Fed's target rate of 2%, and it's actually higher than expected as well. But in conjunction with that, we also saw jobless numbers looking a little bit better, you know. So I think the market was fairly concerned when we got some weaker job numbers over the past number of weeks. But yeah, you know, I still think to a large extent, a lot of it's going to be driven by, you know, what the Fed's next move is going to be. Markets obviously currently pricing in, you know, remaining where they are. But yeah, that's probably going to be a big one, and we're seeing those numbers in the second week of December, I think. But before that, we'll still get PCE numbers, which is the Fed's obviously their preferred inflation indicator, as well as CPI numbers out of the US. So I think that's sort of probably going to be driving markets just in general over the next couple of weeks into the end of the year.
Just looking at what we are seeing in markets, though, I'm wondering if what we normally see with the Christmas rallies on the cards, you know, because it has been a very, very difficult year, of course, but we have seen better screens. In fact, I think one of the things that I read was that markets have actually performed really well over the last few weeks, better than they have in a while. And so are we expecting this to carry on into December and through the festive season?
Yeah, you know, the seasonality trade has always been sort of a reality. I think, you know, with data being more accessible to more people nowadays, I think it might be a little bit more pronounced. And it's actually followed the sort of the general trends very nicely up until now, you know, and typically we do sort of see a rally into the Christmas season. But I do think, you know, the one sort of spanner in the works might be the inflation print. You know, I keep on hammering on it, but you know, we've still seen some of the components of inflation being a little bit sticky. Yes, inflation has come down considerably, but a lot of it's also, you know, comps from previous year that's sort of just statistically sort of figuring into the whole situation. We saw that with a similar thing now with the SARB meeting yesterday, the APC meeting, sorry. You know, there's also the comps are actually starting to come in. So yes, we got a number that's higher that was sort of expected by the market, the latest CPI numbers, but you know, there's a lot of the comp obviously influencing that as well. And we're getting the same thing in the US, you know. So I think everything's going to be driven by the Fed into year end. You know, later today we're getting some PMI numbers. The PMI numbers have been very weak of late, and we also saw some numbers out of Europe this morning. German GDP data that was pretty much driving the DAX lower at this stage. Once again, we saw the German economy shrinking. They obviously had a weak start to the year, and then we had a further drop in the third quarter. You know, so that data, along with some slowing down, especially in the consumer side of things in the US, also starting to see the consumer coming under pressure. I think that's sort of going to drive a lot of the rhetoric into year end.
And then I must ask you about oil. We saw that OPEC Plus meeting being postponed. I'm wondering if this happens often, or if this is also signaling some uncertainty even coming from the OPEC Plus countries there with regards to demand issues and where the global economy is going.
Yeah, no, definitely. I think I touched on it when we spoke a couple of weeks ago. I think to a large extent, what the moves we've seen in the oil price recently has to a large extent been driven by demand. We also saw inventories jump in the US at a much bigger rate than expected. So that obviously is indicative of the fact that we could be seeing some waning demand in oil. And no, to your point, I don't think they necessarily postpone these meetings very often. And we are still expecting, more supply cuts to possibly boost the price from OPEC plus. So yeah, that's going to be an interesting one to watch over the weekend.
And then coming out of South Africa, Jacobus, we held our interest rate steady. Of course, we didn't see much movement or reaction to this one, but I'm just wondering for our global equities and our local equities rather, and our local fund managers, how is this news received right now?
I think to a large extent, it was expected. I think there was also a lot of hope riding on it that, the MPC wasn't going to hike rates again, because we obviously saw the CPI print coming in quite strong on Wednesday, just around about the 6%, which is the upper band of the MPC sort of target range. So I think that did weigh on the market a little bit on Wednesday, but luckily, they decided to stick with an unchanged decision. It was a fairly hawkish rhetoric that we heard, from the governor. I think it was pretty much a unanimous decision to keep rates steady at this stage. But there are, once again, similar story to the US. There's a lot of the devil's always in the detail type of thing. Food prices are rising 10% year on year. I mean, those are really big moves. I think to a large extent, despite the fact that globally markets are pricing in a fairly benign inflation environment going forward, I think we still could see some possible surprises on the upside. And you don't really want to start throwing around things like stagflation, but it's very much a reality at this stage. It's not something we can just necessarily ignore. So yeah, interesting one. But I mean, sort of the hawkish rhetoric was still there. So we could possibly see some future rate hikes if inflation remains more sticky.
Not what I wanted to hear on Black Friday. Jacobus, I'm keen to get your stock pick. But first, let's reflect on counters that have found favor with your industry peers.
I'm going with new broom sweep clean. I think that Jason Quinn's got his work cut out for him. I've been listening to the chairman talk about perform and transform as his key goals. We're buying it. Mm-hmm. At their last results, HEPS was up by 10%, that 14% revenue growth. They've got some exposure in Africa, but they're also looking to, I think the word they used was rejig their wealth business and grow their market share in Africa. And they made a point of saying that they're not chasing other banks who are already in Africa. But I think, the combination of the chair and the new CEO is a good one. And I think they're going to make it happen.
Building on the view, the improving outlook in South Africa, a little more optimistic with a 12-month outlook. I like AVI. I think it's proved incredibly resilient in holding on to its margins through this really tough cycle. We've seen it outperform all the other food producers. And I think as food inflation drops off, they're going to recapture some of their old margin. As people have a bit more confidence, maybe a bit more money in the pocket, they will shop up a little bit back to some of the more luxury brands or the more sort of higher LSM brands that AVI has. And in the meantime, you're getting paid a 7% dividend yield. We're looking forward at a company that's really one of the highest quality businesses on the exchange at a decent valuation. And it's just a nice sleep at night, capture some of the optimism that may play out over the next 6 to 12 months. And if it doesn't, you'll still be fine.
I'm going to go with growth point. So I'm going to kind of build on our theme that we're talking about today about, almost the safer property option. It's typically a bellwether of the South African, well, I suppose, of the South African listed environment. It's not necessarily just South African. So, about 62% of its assets sit within South Africa, 30% in Australia, about 8.5% in the UK. So you do have that kind of spread. It does have obviously an office component as well within the portfolio, but kind of looking at consensus estimates, I mean, we're looking for at least sort of 12 or 13% upside over the next year, and it also comes with a chunky kind of 12% forecast distribution. So that's reasonable. That's above what you can expect from the market on average. And I think in a falling interest rate environment that we could potentially have over the next 3 years, I think that I think you're going to do well with it. And as Grant said earlier in the show, it's these property REITs are maybe a safer option than some of the others. So I'll play it safe today and go with growth points.
All right, Jacobus, keen to get your thoughts on some of those counters. We have Nedbank, AVI, as well as a growth point.
Yeah, you've got to, just acknowledge that all of these are local counters. I think just a comment in general, we're just seeing some fantastic businesses in the local space that are trading at, dirt cheap valuations. I think that's sort of a theme across all three of these, I think, to me, interesting, definitely AVI and Growth Point. AVI, I think they've got a fantastic portfolio of companies, still trading at a big discount. And, we just think that 7% dividend yield, obviously, you've got to take that into account. And a similar thing with Growth Point. Real estate in South Africa in general has taken a massive knock over the last, 2 years odd now. Some of them never really sort of getting out of the whole COVID environment, and I think Growth Point, similar to AVI, it's a much sort of more stable, sleep safe at night business. So toss up between those two, I think.
And which counter are you going with this afternoon?
Further to the same theme, I know it's obviously more exposed to this offshore business, but is Richemont. It's still about 30-odd% off its highs. Yes, and there are definitely some headwinds, still in the luxury space, especially out of China. But we've seen a lot of sort of, positive things coming out of China. The government's obviously stepping in, to assist the local market there. And I think, I don't know what the catalyst is going to be, but at some stage, I think the consumers are going to, start to get more optimistic, and that'll obviously be good for the luxury space. But we also see, that luxury sort of tends to be a little bit more resilient, when we see some of these more higher net worth consumers, not necessarily budging that much when it comes to, interest rates going up, economies coming under pressure. So, and it's just cheap at the moment. Cheap versus peers, underperformed the Swiss luxury index of late. So yeah, and I think it's a fantastic business.
Well, Jacobus, it's always a pleasure speaking to you. Have a fantastic weekend. Thank you for your time. That was your midday markets update with Jacobus Brink from the Schmidt Family Office.